You're welcome to this class. So we are going to be looking at IFRS 15 on revenue from contract with customers. And when we talk about revenue, we're talking about one of the most important item in the statement of profit or loss of any entity. So this standard is going to teach us how do you measure and how do you recognize revenue. And this standard came in around in May 2014 and is a joint project between the IASB and the FASB. So the FASB is the accounting standard body for the United States, that is the Financial Accounting Standard Board, while the IASB is the ones issuing IFRS. So they came together to work on this project, and this standard is going to replace IAS 18 as well as IAS 11. And because of the recent fraud that has happened in in revenue recognition, so this standard majorly wants to bring transparency when recognizing revenue. So, what's the objective of this standard IFRS 15? The objective is that wants to ensure that whatever amount that is recognized as revenue must depict or represent the consideration expected by the entity from the transfer of promised goods or services. Now, what this is saying is that if you recognize 50 million in your books as revenue, that 50 million should be what you are expecting in form of consideration. So what you eventually get should not be higher nor lower than that. The 50 million must reflect or depict the consideration you are expecting from the goods you have transferred to another party, or from the promised goods you have transferred to another party. So that is the major objective of this standard. Now, then with IFRS 15, how do you recognize and how do you measure revenue? This standard uses a five-step model, meaning there are five steps before you can eventually arrive at revenue recognition. And the step one is identify the contract with customer. That is, there must be an existence of a contract. And this standard defines a contract as an agreement between two or more parties that create enforceable rights and obligation. That is, it must have legal and economic consequences, meaning that if a party to the contract does not perform his own obligation, then the other party should be ready to exercise his own rights, either suing the person or finding a way to collect his money. But each party must respect their rights. So it sees contract like that, an agreement between two parties that creates rights for one party as well as obligation for another party, and each of them can enforce their respective rights and obligation. And a contract with a customer is within the scope of IFRS 15 only if it meets these five criteria. Number one is that the parties must have approved the contract. Okay? So they must approve it either in writing, either orally, or in any other way that they approve contracts in any other way. That's one. Two is that each party's rights regarding the goods and services to be transferred can be identified. So each party must know its own right and obligation. So they must be able to identify their rights. And the third criteria is that the payment terms for the goods and services can be identified. So the payment terms, that is, when is the party that has a right supposed to collect his money and the party that has an obligation supposed to pay or deliver goods or services. The payment terms must be clearly stated. Are we paying one off or are we paying instrumentally? Payment terms must be clearly stated. And fourth is that the contract must have commercial substance. And commercial substance meaning simply means that there must be a change in the entity's future cash flow, meaning that money must change hand. Okay, money must change hand. That's what commercial substance mean. And finally is that it's probable that the entity will collect the consideration to which it will be entitled. And these are the five um, criteria for a contract to be in the scope of IFRS 15. So you have to know these five. Going forward is that when a contract does not meet the criteria above that we have mentioned, and an entity receives money or consideration from a customer, then in that case, the entity cannot credit revenue, it cannot recognize revenue. What you recognize is a liability, specifically a contract liability. A contract liability. Because we see it as you have not earned revenue. In fact, you are just owing money, you are holding money on behalf of that party, which you might likely pay back if you don't meet this criteria. So that's why they call it contract liability. Please note that. However, you would eventually recognize revenue if any of these two happens, right? One is that if the entity has no remaining obligation, that is, he has delivered the goods, or the contract has been terminated. Okay, contract has been terminated, and the money he has received is non-refundable. Then you will just recognize it as revenue. So probably debit this contract liability, and it will credit revenue. Okay, so these five criteria is extremely important before you can recognize revenue. If these criteria are not there, what you can recognize is a contract liability. Now, talking about contracts, um, when you have separate contracts, an entity might have to combine those separate contracts and see them as one. If the contracts are negotiated as a package with a single commercial objective, or if the consideration to be paid in one contract depends on the price or performance of other contracts, and thirdly, if the goods or services promised in the contract can be delivered as a single package, right? So when you have separate contracts that are negotiated they are negotiated as a package, they have a single commercial objective, meaning that they will be delivered as a single package, and the price you will pay on one contract or the price you will receive on one contract depends on the performance or the price of the other, then those are not separate contract. It's in fact a single contract. So you combine those ones. So that's combination of contracts. Again, a contract can be modified. So that's contract modification. And a contract is modified or it can occur when there is a change in the scope or price of a contract that is approved by the parties to the contract. So when there is a change in the scope and there's a or in a change in the price, then we have a contract modification. And when you modify a contract, okay, then that modification will be seen as a separate contract. Okay, it will be seen as a separate contract if any of these two conditions are present. One is that the scope of the contract increases because of the addition of promised goods or services. Okay, meaning that they say you should come and deliver more goods. You have a contract that says deliver 50 cars. They now call you again and say, okay, deliver additional 20. right? That additional 20, you have to see it as a separate contract. You cannot see it as part of the existing one. They'll probably write up a new contract for that. And two is that the price of the contract increases by an amount of consideration that reflects the entity's standalone selling prices of the additional promised goods or services. That is, the price changed, and that change in price reflects the amount you will have sold that item ordinarily, right? So that's what they mean, but they meant by standalone selling price here. So if the change in price reflects the entity's standalone selling price of the additional promised goods or services, then it's a separate contract, right? You won't see it as an existing contract. So yeah, they said you should come and deliver 20 cars, and each car is let's say 1 million each. Each car is 1 million each. So the the supplier then come and say that he wants to increase the price to 1.8 million each. You see that increment of 800,000, you have to write up a separate contract, because when each car is 1 million, you don't increase it each car to 1.8. That additional 800 is as good as the price of each one already. So there is like is a separate contract, because it is the increase represents or reflects the standalone selling price of additional promised goods or services. Okay, so they define standalone selling price as a price at which an entity would sell a promised goods or services separately to a customer. Okay, so that's the idea. Note this time, because they can ask you to explain it in the exam. It's just the price you will sell an additional goods or a promised goods or services separately to a customer. It's just the price you sell it. Right. Okay, let's look at this question very quickly. And it states that an entity promises to sell 120 products to a customer for 12,000 naira, 100 naira per product. The product are transferred to the customer over a 6-month period. The entity transfers control of each product at a point in time. After the entity has transferred control of 60 products to the customer, the contract is modified to require delivery of an additional 30 products to the customer. Okay, so in this first paragraph now, they said the guy should he wants to sell 120 product to a customer. Then the customer says, okay, that after he has delivered 60 out of that 120, the customer says, come and deliver additional 30. That means the total comes to 150. So this modification, are we seeing it as a separate contract, or let's see. In the second paragraph, they said when the contract is modified, the price of the contract modification for the additional 30 product is an additional 2,850 or 95 naira per product. They now went ahead and said that the pricing for the additional product reflect the standalone selling price of the product at the time of the contract modification, and the additional product are distinct from the original product. We are now asked that does this contract modification constitute a separate contract? Yes, from what I've read, it is a separate contract, because there is a change in scope as a result of delivery of an additional promised good or service, which is this 30 additional products. And they told us here is that the increase in scope resulted in a change in price, and the price of each additional product is 95 naira per product, and it said that it reflects the standalone selling price. That's the key word there, because that change in price as a result of the additional promised goods or services must reflect the standalone selling price of the product, of the additional product you want to deliver. And they said it here already. So the solution there is what I've mentioned already. He said contract modification for the additional 30 product is a separate contract. Okay, because it increases the scope of the contract because of the addition of promised goods or services that are distinct. And two, the price of the contract increases by an amount of consideration that reflects the entity's standalone selling prices of the additional promised goods or services. Okay, and that's the solution to that. So they went ahead and says that the entity shall recognize revenue of 100 naira per product for 120 products in the original contract and 95 naira per product for the 30 products in the new contract. Okay, so this other part is saying that what if the additional 30 product does not reflect the standalone? So that means it will be a separate contract. Okay, so it says there that it will be like a termination of the original contract and the creation of a new contract. So that additional 30 will be like a new contract. So they explain that the remaining 60 products, you recognize the revenue. The additional 30 products, you recognize it at 95 naira. So 8,850 revenue. Okay, now that's the step one, identify the contract with the customer. Now the step two is to identify the separate performance obligation. So what is a performance obligation? A performance obligation is just the promised goods or services that the supplier must deliver. Okay, so after we have established that there is a contract, then the next step is to identify, okay, what goods are we supplying exactly, right? And the way you account for each of the goods, you account for them separately, only if they are distinct. Okay, so each of those goods must be distinct, right? So, and you're going to recognize revenue on each distinct good or services. And when we say distinct, it means that if it is sold separately, because it has a distinct function and a distinct profit margin, right? So if it is sold separately because it has distinct function and distinct profit margin, so we recognize revenue for it separately. So even if you issue an invoice to a customer and you want to render five different services, so what we are saying here is this: are you seeing those five services as one, or are you seeing each of them as distinct? Okay, so that's what we want to look at here. So IFRS 15 states that the good or services that is promised to a customer is distinct if both of the following criteria are met. One is that the customer can benefit from the good or services on his own. Okay, it's just like you bought a phone. The phone is good to go, it's a distinct goods or services, right? So it's like you bought a television, it's a distinct goods or services. So that's what we're saying. And or maybe they can enjoy it together with other resources they have. It's just like you bought a television. The television will not work until you actually plug it into a socket, or if you are using, or if you want to watch maybe YouTube Kids, or you want to watch Disney World, or you want to watch maybe Prime Videos on your TV, you probably would have to buy an internet. Okay, so that is not part of what you bought. What you bought is a TV. So whoever has sold it to you will have recognized that TV as revenue in his books. And that's one. The customer can benefit from the goods or services on his own. Two is that the entity's promise to transfer the goods or services to the customer is separately identifiable from other promises in the contract. Is separately identifiable. So this thing also means that a particular good or service you want to offer to a customer, if it is separately identifiable, then recognize the revenue on its own separately. Okay? And what do you mean by separately identifiable? It means three things here, according to IFRS 15. One is here, it does not provide significant service of integrating the goods or services with other goods or services, meaning that that goods is doesn't serve as an input for another goods. It's just like you want to sell roofing tiles and you now promise the customer that you will deliver. So you cannot see delivery as separate or a distinct or a service that is segment identifiable because you have promised the customer that you will deliver. So the delivery is an input to the for to you selling the roofing tiles. So it is not separately identifiable. So separately identifiable means it is not an input to to deliver a combined output. It's separate. And also is that the good or service does not significantly modify or customize another good or service promised in the contract. Okay, it doesn't modify another, and also it is not highly dependent on another. Okay, so that's what I mean by separately identifiable. So here, you need to understand that before you can recognize revenue, you need to identify the separate performance obligation. And what we mean by separate, it means that they must be distinct. Each good or service that you recognize revenue on must be distinct. And they are distinct if the customer can enjoy benefit from the good or service on his own. And also is that it's separately identifiable. That means it does not is not an input to another good or services. It does not modify another good or services. It does not depend on another good or services, and that. Now let's look at this question. It says that Wiki Limited, a contractor, enters a contract to build a hospital for a customer. Wiki Limited is responsible for the overall management of the product and identifies various goods and services to be provided, including engineering, site clearance, foundation, procurement, construction of the structure, piping and wiring, installation of the equipment and finishing. Wiki Limited and its competitors regularly sells many of these goods and services separately to other customers. Explain whether the promised goods and services can be treated as a separate performance of the. For me, I know because Ricky enters a contract to build a hospital, right? So each item on his invoice that he wants to do or execute to build the hospital, you cannot see engineering as a separate performance obligation because it's without engineering there won't be site clearance, without site clearance there won't be foundation, without foundation there won't be procurement. So they are not separately identifiable, they are dependent on one another. So all of them are seen as a separate performance obligation. So we cannot see each of them as separate. So and that's what the solution is saying here, that the promised goods or services are not distinct within the context of the contract. This is because the entity provides a significant service of integrating the goods or services, that is, the input, into the hospital, the combined output, for which the customer has contracted, right? So Ricky shall account for all the goods or services in the contract as a single performance obligation. Okay, let's look at this other one. He says that Kako Limited, a startup tech company, develops an app for use by businesses. It enters into a contract with the customer to supply the following: license to use the app, installation service. This may require an upgrade to the customer operating system, technical support for 4 years, and 3 years of update. And also that the installation service can be performed by Kako Limited competitors and it does not modify the app. The app can remain functional without the update and technical support. Explain whether the promised goods or services can be treated as a separate performance obligation. Okay, let's look at it. So, what Kako wants to deliver, he wants to deliver these 4 items, and I'm sure he must have put these 4 items on a single invoice. So the question is that are you seeing each of these items as separate, or are you seeing them as one or as single? Looking at the information they gave us here, we are told that the installation service can be performed by a competitor and it does not modify the app. Therefore, the installation is a separate, can be separately identifiable because it does not modify. It's not an input. It does not depend on, right? So it's separately identifiable, right? So that's one. Two, they told us that the app can remain functional without update and technical support. So when the app is working, technical support is not needed. Update is not needed. So because the app is functional without them. So each of these service are separate. They are separately identifiable, so we cannot see them as a single performance obligation. So we are going to see each of them as a separate performance obligation, and that's what this solution is looking at. Okay, we'll stop here for now. We'll continue from step 3 in the next video. Thank you for listening.